Over the next 1 hour, we will try to cover uh, uh, some recent updates on Carnelian, as well as a quick update on Bharat Amritkal Fund, and overview of our portfolio across various strategies. And lastly, Vikas will cover market outlook as well as Carnelian view on various sectors as well as valuation, liquidity. So this will be the broad flow of today's call. So let me first cover up recent updates at Carnelian. In fact, last quarter has been very eventful for Carnelian, as we have completed 5 years of our incorporation, and which we have celebrated with our investors as well as with our partners. In fact, a few of the industry stalwarts were part of our celebration, including Mr. Sandeep Bakshi and Manish Chokani, who were chief guests at our 5 year celebration. And also, I take immense pride to announce that we have recently crossed $1 billion of AUM. Bharat Amritkal, which we have launched just 4 months back, we have been able to raise 2,300 crore, which has been one of our fastest fundraise. In fact, we took almost 4 years to raise first 2,200 crores, and this 2,300 crore we took just 4 months to raise, and we are seeing very good inflows in this fund, as well as I think the way the portfolio has been created, that I will cover in the subsequent slides. We have also launched our first offshore fund, which is based at Gift City, Ahmedabad. We are now 55 Carnelians who are being part of our journey. We have spread our sales office across Bangalore, Delhi, Hyderabad, and Ahmedabad. And also recently we have doubled our office space in the same premises. We have taken another office to accommodate our growing team size.
Sir, before we proceed, I'll just share a screen, have a glimpse of our 5 year celebration.
साल के प्लान कैसे बनने चाहिए और कैसे इम्प्लीमेंट होने चाहिए, ये सीखिए कार्नेलियन से, विकास खेमानी से.
Congratulations, Swati and Vikas and the entire Carnelian team for completing 5 years.
I met you as an investor, but I know you now more as a friend. My best wishes to you for the next 50 years.
Thank you very much for being here. It means a lot that all of you are here for us to celebrate this milestone in our journey.
Thank you, Tanay. So let me quickly cover Bharat Amritkaal Fund. In fact, many of you must have attended the launch call of our Bharat Amritkaal Fund, but I will just cover briefly. In Bharat Amritkaal Fund, our endeavor is to capture wealth creation opportunities in India as the country moves from a developing nation to developed nation. In fact, few of the things which it will result in 7 to 8x increase in per capita income, GDP of the country, as well as India's share to global GDP will become 4x from 4% to 16%. And as it happens, it will result in significant wealth creation opportunities across various sectors, subsectors. And our team last 4 or 5 months, they have done enough research to find out those sectors, subsectors which are likely to grow exponentially during the Amritkal period. In fact, during Amritkal period, the first 10 years of Amritkal period, the country as well as these sectors will see exponential growth. And as the country's or the GDP size grows to a large scale, thereafter the growth will also graduate to a matured level. So our endeavor is to capture those sectors, subsectors quite early. And so few of the mega trends which we have highlighted under Amritkal, that India will play a major role being factory to the world, being office to the world, and these things put together will result in unprecedented consumption boom in the country. So the kind of portfolio which we have created, it is just a glimpse of sectoral allocation. We continue to remain our positive stance on manufacturing. Around 31% of our portfolio is in manufacturing. First time we have become positive on consumption. Mainly because of the rural spend increasing as well as the kind of discretionary consumption which is likely to increase during Amritkal period. So consumption names are now comprises 20% of our portfolio. The banking and financials 19%, and rest is between service exports and infrastructure. So as you can see that the performance of Bharat Amritkal Fund since launch, it is the performance of last 4 months. It has delivered around 14% absolute return. If we annualize it, it is around 50% on an annualized basis return. And the kind of portfolio which we have created, it is truly a distinguished portfolio, a differentiated portfolio with a few of the sectors, subsectors which are likely to do well during Amritkal period. Let me just take you through how our existing portfolio is doing. So as you can see that the performance of our existing portfolio is consistent across various periods, whether it is 1 month, 3 months, 6 months, 12 months, 2 years, 3 years. And during last 12 months, the portfolio has delivered returns in the range of around 45% to 84%. And few of our funds as well as strategies have delivered, like compounder fund has delivered 223% of absolute return since inception, which means any investors who have invested 1 crores with us 5 years back, that 1 crore is worth 3.2 crores now post taking our fee and all expenses. Similarly, in shift strategy, if anybody would have invested 1 crore with us, that 1 crore is worth 4.38 crores right now after taking all our fee and expenses. Similarly, all our other strategies, whether it is compounder strategy, YNG strategy, and the bespoke strategy, they have delivered decent and consistent return with a sizable alpha vis-a-vis benchmark. And the outcome of these returns is mainly the quality of portfolio which we have created. In fact, if I take you to the quality of portfolio, we call our portfolio faster, stronger, yet cheaper. As you can see that all our strategies, whether it is capital compounder, structural shift fund, or Bharat Amritkaal, the expected return on revenues and earning is upward of 25%. Revenue growth is ranging between 15 to 20%. ROE is upward of 18% across. And when I see the leverage of the portfolio across all strategies, the debt to equity ratio on a portfolio level is just 0.1. So none of our portfolio companies are having a large leverage in their balance sheet. In fact, many of the companies are sitting with surplus cash. Not only many of the companies are sitting with surplus cash, they are also sitting with surplus capacity, like capex done, earning yet to come, which will likely to bring large amount of operating leverage and profitability going forward. In terms of price to earning divided by growth PAG ratio, as you can see that the entire portfolio's PAG ratio is within the range of 1 to 1.3. So even in today's market, when we are seeing that the stocks have become too expensive, our portfolio is still reasonable when we compare it with respect to the growth of the earning. And the most important part is the portfolio beta. As you can see, all of our funds, whether it is compounder, structural shift, and Bharat Amritkal, their portfolio beta is in the range of 0.6 to 0.9. What it says that the return which we have delivered, those return has been delivered by taking a lesser amount of risk because our portfolio's variability or volatility is much lesser than benchmark. So with this, I cover the portfolio performance as well as portfolio attributes. Now, I would like to invite Kunal to take you through few of our portfolio and trends and exits, and as well as he will cover other aspects of the portfolio. Yeah, over to you, Kunal, please.
Thank you, Manoj. Good evening, everyone. Hope I'm audible. So, all this while we have been talking about our investment framework, which has helped us hold good ground and picking up stock picks. We've talked about Magic, where we are talking about, a good business, having change in CEO, having change in promoter, large capex cycle coming on stream, business strategy change, the capex cycle coming on stream. Sticking to that, we have picked up few stocks basically. So GSK Pharma, Canara Bank are all a result of our Magic basket. Now, if you talk about GSK Pharma, it was already a very strong domestic business, having brands like Augmentic, Colpal already there. But what was lacking basically was growth and renewed focus on India markets. With change in CEO leadership change, we realized along with the parent focusing on India, there have been umpteen number of products in the pipeline which are going in trials from the parent company, which basically gives a good room for growth other than the brands which are already well established. Similarly, also at the same point of time, Canara Bank, again, there was a leadership change with Mr. Raju coming in, having 3 decades of experience across the banking sector. Dabur, again, as consumer stocks, we have avoided all the while because we were not comfortable with the valuations, also growth basically not coming there. But about a few months back, we realized that rural is something which is kind of picking up. Volume growth in the rural segment is something which is good. Dabur, again, having a good mix of products, established brands, having good presence in rural, saw good uptick in the rural, which was better than the urban growth, which we believe should kind of continue going ahead with the monsoon coming good, with the farm loan waivers and rural income kind of picking up. So that was the new pick that we kind of picked up. Concur, again, is basically a Magic framework stock for us, where we believe with DFC coming in and CEO change, the prospects basically for the growth in business and margin expansion are pretty robust. Max Financial Services, again, we have all seen life insurance company facing challenges on account of regulatory changes that have been happening in the sector on account of surrender changes. Right. So we believe that all of that is largely behind, factored in the price. Stocks have done nothing in the last 3 years. Max also has saw a magic event in the form of Axis now becoming a major shareholder with 19% stake in Max Life Insurance. which basically should augur well for Max Financial Services, as Axis also is one of the banker partners and contributes about 65% to the annual premium for Max Financial Services. Similarly, we talked about capex, large capex coming on stream as also one of the magic events in our investment framework. Innova CapTap again is one of those companies which, on a gross block of about 200 250 odd crores, is adding 300 crores of capex, which is in WIP and which will come on stream. Again, a first generation entrepreneur. CDMO space we are very bullish on, catering to the formulation business in India. So again, a magic basket for us. Ola is again a distinctive pick for us. We have been talking about avoiding a lot of new age companies for quite some time because of disruption risk, because of hard assets being not been there on the ground. In case of Ola, we believe that it's not one which is prone to disruption, but is disrupting. But at the same time, there are hardcore assets that have been created on ground, be it the future factory, be it the EV factory, which has been set up in the last 5 years at a rapid pace, which is none to, also the incumbent players have not shown the kind of speed and acceleration that Ola has shown. So that's again one of the magic stock picks for us, basically. These are the few stocks that we have added. Exits again is a result of our selling framework, which is also keeping in mind the type C opportunity risk. So the exits in the form of HCL Tech was again where we believed that the valuation gap between top IT players in comparison to HCL Tech was narrowing, wherein deal wins in other players was much better in comparison to HCL Tech, along with inconsistency in the ER&D play that HCL Tech had. PNB again, type C risk and risk reward. We always talk about in our investment framework. So we believe that stock has run up much ahead in terms of risk reward. At one hand, you have Canara Bank, which is consistently clocking 1% plus ROA, already at 16% ROE, in comparison to PNB, which trades at expensive valuations in comparison to Canara Bank, but still ROE would be like 3-4 quarters away, along with a huge capital raise on the way. So that was, again, sticking to our selling framework has helped us guide there. These are the few ideas that has worked for us in the last 12 months across different strategies. Again, one observation over here is that it comes across different sectors, and largely, again, Magic framework has helped us along with Connect framework. Connect is again a framework where we do a lot of due diligence, connecting with employees, visiting factories, connecting with network partners. Senco Gold is one of those examples which where the post IPO. During IPO, the stock was available at 15 times price earning multiple. We did a lot of due diligence connecting with channel partners. Our team visited their Kolkata sales office showroom. We visited the factory where they manufacture. We did a lot of due diligence with basically partners who are working with them, and we found a lot of good feedback on the promoters. Again, Magic framework, which is a classic example of good business, right, along with growth, multiple re-rating. The stock now trades at almost 35 times price earning multiple from 15 times price earning multiple. PCBL again is an example of change in industry structure, basically where there was a change in industry structure where almost 30% of the supply kind of going out of the China helped stabilize earnings. So these are the few ideas which have worked for us, largely coming out of our investment framework and Clear and Connect framework, which have been the guiding force for us, helping us garner these returns. I'll hand it over to Vikas to take it forward from here. Vikas.
Hi, good evening, everyone. So I think I'm sure, broadly everybody is kind of thinking around what's happening in the market, or how should we see from here, of course, markets have touched almost new high, and post with this new development on the Fed. So we'll talk about over next 10-15 minutes on how we see markets. And markets, according to me, always has been function of three things, right? Earnings growth, liquidity, and broadly around valuations, right? So earning, we've been quite seeing a reasonably broad-based momentum in the earning. As you could see that over next 2 years, 16% is the estimated growth at the index level. But if you look at in slightly wider space, you will find far more earning growth. So I mean, especially in the mid and small cap space, the earning could be between 20-25%. Of course, you have to choose your own portfolio. So as earlier Manoj was showing that our portfolio earnings growth is between 22 to 25%. While market is growing about 16%. So, and corporate earnings are right now, reasonably widespread between financials, consumption, manufacturing, even, in the sectors like real estate, where we are seeing very aggressive. Many infrastructure players are growing very well. So it's a function of many things. We have, rising utilization. We have, very significant amount of growth happening in the demand scenario. Leverage part is yet to kick in. Massive investment is happening on the infrastructure spend. Roads, railways, ports, airports, everywhere. So that kind of drives the demand. And at the same time, we are seeing private capex has picked up significantly. Every business, mid, small, large, has been expanding, putting up new capacities. So it has kind of opened up that virtuous cycle of reasonably good growth profile. And we do think that we will see reflecting that in the earnings growth. And broader estimate, if you see, pessimist would have 15% earning growth, optimist would have 20% growth. But the range of the growth is between these two numbers. And as long as we have this range kind of being maintained, we will, I think, continue to do well. And I see this remaining pretty much this at least next 3 to 5 years. Now, obviously, next we look at valuations. I think there's a reasonably widespread narrative going on. Markets are very expensive, and I think rightfully so, because I think many times people make this kind of judgment looking at many outliers which we are seeing in the markets. But at the same time, we thought let us look at what are the kind of numbers. So if you just look at Nifty 1 year forward, the 16% kind of growth is trading at 21 times, right? And if you look at many stocks specific, while some of them are very expensive, but some of them are still at a reasonably good peg ratios. So even if compared to historical times, India is not trading very expensive. We are, of course, on the other side of the range, but at the same time, but whether it is on the earnings growth, whether it is on the ROA profile, whether in the structural repair of the economy sectors, we are also on the outlier side of the growth. So if that is the case, then how come Nifty will be cheaper? Of course, if you look at same thing, market cap to GDP ratio, India has inched toward closer to 1.5, which is a slightly an outlier. But at the same time, I think to that extent, India can't be called cheap, but I would not call it very expensive. Also, because given the fact that sustainability of the growth and everything else is there, if you just move to the next slide, Tanay, valuation of this is a point in the past also we have spoken about it, and I want to explain this slightly more in detail. Valuation of any asset class is a function of three things: ROE, I mean yield, growth in yield, and discounting rate. And if you look at in case of equities, ROE is the yield, earning growth is the growth in the yield, and your discounting rate, which is a function of risk-free rate as well as the risk premium. Now, if you look at India's earning growth, we spoke about ROE is at 15-16%, which is very, very, as compared to any market in the world, we are high. And as compared to our historical time, we are at high level. Same way, earnings growth, 15 to 18% earning growth. Again, as compared to sort of only at the time we saw this kind of earning growth was 2003 to 8 period or 5 to 8 period. No other market today currently offers this kind of growth. And lastly, our interest rate cycle, if you also see, we difference between 10-year US and 10-year India is lowest ever. So our cost of capital is one of the low ever. Our risk premiums are coming down. So if all these three things are, structurally in a good place, why India would trade cheap, or why would India be trade even at a historical valuation? It is supposed to, or it is likely to trade higher than the historical valuation range. And that's the reason we are not kind of finding market very expensive. And one should understand, with the interest rates coming down, and like I said, discounting rate is a very big play in understanding the valuation. So we all understand very well that a 2% drop in the discounting rate, what happens to a fixed income paper, what happens to yielding real estate assets. But in case of equities, it is not very, very intuitive, right? Uh, uh, but what we did was that, we just took some number, everything else remaining same. A 2% drop in the discounting rate of equity portfolio changes the equity valuation by almost 35%. So if, let's say, earlier 16p was fine, with the only 2% change in the discounting rate, 22p should be fine. Right? That's the kind of sensitivity equity has. And that is what, at least we're trying to say, that don't look at India only, judge India looking at the historical valuation, say India has become expensive compared to past. If you have that perspective, you will keep on missing the opportunity, keep on looking at the looking things differently. So all I'm just saying is that we are not making a point that there are no points of exuberance. We are not making a point that there are no pockets of overvaluation. It's just saying that if discounting rates change, equity valuation do expand, and keep this in mind. Now, depending on whatever views anybody has, whether interest rates will come down further or not, risk premiums will come down on India or not, that will of course determine your view of on valuation. But at least keeping this particular fact in mind will help you understand. Now, the third aspect of markets is liquidity, which we all know that how liquidity has been very, very strong, specifically in case of both in the recent past in the domestic investor side. We have seen a reasonably large flow coming from SIP and local investors, and I don't think that is going to change anytime soon. We just did have one small sensitivity today. Our household exposure to equity is about 4%. 10 years ago, it was 1%, right? Uh, we just did a sensitivity. If this 4.7% goes to 10% by 2035, China is 15, US is 35%, India will receive $2.2 trillion of additional flows from domestic investors. This is the kind of money which is expected to come. Of course, it might be up and down. I'm telling you a 10-year trend. For a 1 quarter here, that can be there, but I think it is going to be sustainably here, because most of the SIPs are in the nature of non-reversal. People have taken, just like how 401k accounts were in US, and just like how their PF accounts, money goes from their account. So this number is here to stay, and which is a very, very interesting change. As far as the foreigners' money is concerned, we have been seeing money flow going away from the Indian markets and emerging markets. That is always the case whenever Fed raises interest rates. So if you see, Fed started raising interest rates, it took all the way to 5%. And that is where most of the money went out of from emerging market. And India being part of the emerging market, India also witnessed that kind of outflow. But this is a 30-40 year rule playbook, that whenever Fed raises interest rates, they pull out money, and when Fed start cutting rate, money comes back. And I think with the recent comment, and we've been saying this for last 3-6 months, that it has peaked out, it will come back. Now whether it can be a matter of 3 months, 6 months, and we've already seen some move happening in that direction with the recent comment by the Fed chair. So clearly it looks like that we are in for a good flow coming from FIIs. So we will have a reasonably good easy liquidity scenario, both from domestic as well as the international funds. If you can move to again, and if you just see a lot of large, funds, Indian mutual fund industry is about close to 30 lakh crore, and they are sitting almost on 5% cash, and that is almost close to 1,50,000 crore kind of cash. So there is a very large amount of cash still being is in the system. That's the reason every time you see market corrects, a market doesn't correct a lot. There's buying always available on the sidelines. Then can you move the slide, please? At this point, I've already covered. So I think in summary, if you see earnings, valuation, liquidity, we think they are all in place. We don't see a major risk coming from any of these segments, at least in medium term to next, at least in medium term. And of course, we will keep a watch on it very, very closely. Anything changing, we will definitely sort of react to it. But currently, at least we are believing that at least next couple of years, it is all in place. Uh, yeah. Tanya, can you move, please? So maybe I'll let Kunal cover this quickly, and then we will go. So Kunal, can you currently, and I'll just cover this and then let Kunal cover individual sectors. So currently, sectors which we are positive is private banks. I know private banks have covered little. Banking sector has kind of underperformed in the recent past, but we are not perturbed by that. We think Indian economy cannot grow to the size of from $4 trillion to $30 trillion without a robust banking sector, and banking sector is in a very, very good shape. Of course, we reduced our exposure some time ago in the banking overall, but we continue to remain positive, and we have recently also invested. Life insurance space again continues to remain very good. Consumption segment, last 5 years we never bought because we found risk reward was not invested and was not in favor. First time in last 3-4 months, we've been kind of investing into consumption related stocks, especially where we see a good risk reward falling in place, both in rural as well as the discretionary side. IT, we've been continuously bullish. You heard us many times, even when sector was not doing well, there was a period when sector did not do well. We kept on saying that it's a phase which will pass, just like how right now financials are, going through a tough phase. We continue to believe that that will pass and that will do well. Same way, IT last 1 year has fabulously done well for us. Manufacturing continues to be a very, very solid sector for us. And so these are some of the sectors we are very, very heavily screwed on and focused on. Sectors where we are very careful and watchful are, where there is a little bit of a froth built, uh, 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 where I think, capital goods. Can you stop moving the cursor, please? So capital goods is where, we think capital goods, defense, railways, where we think a lot of frothiness is there right now. Sectors will do well, opportunity is there. But, investing, one of the key focus is that there has to be risk reward in the favor. And as a result of that, we right now very, very cautious on those segments, despite opportunity space being very large. Kunal, can you cover some of these sectors?
Yeah, sure. So I think I'll quickly cover, one thing what we have done is every sector has got a few important points as a fund house, which we kind of close very trackly and which gives us the confidence for that particular company as well. Like banks and banks, specifically credit on NBFC credit, we have always believed that a strong liability franchise is something which is very important. Technological upper hand, considering the way things are playing out. Strong risk culture, again, is something which is very important. So this is what we call Carnelian lens, which are few important parameters which are very important for us, come what may. Again, coming to this quarterly outlook, quarterly earnings and outlook. So loan growth momentum continues to be pretty robust. Well, a little slowdown is there on the retail growth side because of the regulatory changes that have been done, rightfully so, because it was growing at a rapid pace. CASA again continues to remain challenged, but again, liability franchise, which are very strong, have been able to garner deposits and also CASA. NIM basically again largely has moderated, right, and there will be a scope for improvement from here on. NPA is not worrisome as yet. Regulatory actions continues to be monitored. We continue to select private banks and NBFCs with strong liability franchise and strong technological head start for companies. IT again, we like sectors where the opportunity size is kind of not disrupted. We like space in the IT where the opportunity is just folding up. ER&D we have talked about is at a place where IT services was about 15-20 years back. Again, earnings this quarter we have already saw BFSI is the one which has been leading the pack. Deal wins have kind of resumed back, and it is one of the best place to play the US interest rate cycle. Tane, if you could move ahead. Consumer staples and discretionary, again, we have discussed that rural is something basically which is kind of should do good and augur well. Over here, we are basically focused on companies which have got strong brand distribution reach and also at the same time expanding their opportunity size by capturing adjacent verticals. Again, over here, we have avoided the space for many years. We have just entered. This is the space which we are very bullish on: pharma, healthcare, and CDMO opportunity. We look at track record of compliance, which is very important when it comes to pharma, healthcare. R&D driven culture, capacity on ground at this point of time becomes very important, along with distribution reach and strong product portfolio. For the pharma sector, domestic is something which has been doing very good. US price erosion has largely come down. That is getting reflected in the numbers that have been coming out by the companies. And also at the same time, CDMO is a very big opportunity that is opening up for Indian players. There are a few handful of players who are capturing this opportunity, which large capex already done or in the phase. We continue to remain positive basically on this space, right? So that is again something which we are very positive on. Tare? Chemicals and APIs, again, on the commodity front, we are focused on companies where there is an import substitution play. We look for companies which have got a domain expertise, a track record of displaying that domain expertise with capex which is coming on stream, and the most important being the ability to withstand cycles. This is a little bit of contra play because here the demand has kind of seen a little bit of mutedness, but again, margins are at record lows. Volume growth continues to be robust. Once we believe margin comes back in places where companies are catering to import substitution products, and at the same time, companies which are export focused, catering to diverse industries with capex already done, should see meaningful trajectory in earnings. Capital goods and power, again, basically, this is a sector where we are selectively positive because valuation in certain pockets are beyond 2007 peak levels, with ROE profile much, much worse than what it was even in 2007 kind of case. So again, selectively positive on capital goods and power sector. Valuations over here needs a very close look. Automobiles, again, we try to look at companies basically which should not see disruption risk, which is the top. Again, increase in content per vehicle is something which is very important, along with export and import substitution play out here. We continue to remain positive on two-wheelers, tractors, and select auto ancillaries out here. Right, telecom and telecom related ancillaries, again, we continue to be bullish because, again, in related ancillary players, there's a very big opportunity size which is opening up, and a few handful of players catering to that opportunity. Again, on the domestic front as well as the export side. So we continue to remain constructive on telecom as well. So I'll take a pause here.
So I think, some of the sector which Kunal mentioned, and, and I'll probably only add on one or two comments on some of the names like automobiles. Despite, little bit of recovery, India has not still gone back to the pre-COVID levels of volumes, in case of most categories. So still, long way to grow. We are seeing that chemicals, CDMO is what probably IT was before, earlier. So I think CDMO is a very big trend over next 10, 15 years. And that's it. And I do believe that in that space, many large 2, 3, 5 lakh, 10 lakh crore market cap companies will come out. And our objective is to kind of keep identifying, those companies which in fullness of time can become very large from where they are. So I think the idea is to have, once you have this perspective of a space from a long-term perspective, then you don't really trade in, trade out. You just kind of stay put and identify the companies which can capture that cycle very well. So in each of the spaces, I think our endeavor is to, whichever product we are invested, to look for large opportunity spaces and keep identifying those companies, and of course, whatever technical movement needs to be done, we will definitely do that. If you can move. So I think in some summary, basically, India, we are very, very bullish in medium term to long term. In short term, given where markets are, obviously after any sharp rise, always there's a fear of correction, which is right. I'm not saying that. So only way we can handle is trim down our expectations. Maybe we might have lower returns in a probably next 6 to 12 months time. But that should not deter us from being part of a long-term opportunities, because nobody can time market. As we all have heard, We don't think markets are expensive, but at the same time, they are not cheap. Uh, Pockets of exuberance is surely visible, and we all can see that. And I can tell you, I've been in the markets, for a very long time. We have been seeing. I mean, I always start worrying about the risk when the quality of the deal starts dropping significantly, and I can see in many cases, today quality of the deals have really poor quality business, poor quality managements have started getting good valuation in the market. And to me, that's a very big sign of worry. We've been seeing that many, operator kind of players have become suddenly very visible. I mean, preferential allotments are happening in poorly quality companies. I mean, other day somebody called me from a very small location in Rajasthan saying that I am taking a preferential allotment in this company. Do you have any view? And I was saying, sir, this is not even you should be considering. But these days, people, there are a lot of pockets of money available in different parts of country, and that's what I think access to technology has done. And as a result of that, I think many uninformed, unprepared, un sort of qualified investors are being fooled. And I would say that time is to be very, very careful. And I keep telling our team that our risk antenna should go 3 4 times higher now than normal, because in these are the times when you are very prone to make mistakes because your confidence level is very high. You are sitting on a good performance, you have made good money, and that is true for everyone, not only for us, including all the individual investors who've been trading by themselves. So when the confidence levels are high, markets are working, the risk levels tend to go up, and we pay less attention to the risk. So I'm not saying that risks are not high. One has to be extremely careful in terms of what one is doing. The only point I can maybe leave you here is that because risk is right now everybody's top of the agenda. And how does one look at risk? We don't say systemic risk, though, I must say that. And why don't we see a systemic risk? And I will like to build that perspective for all of you. Historically, if you look at last 10, 20, 30 years of history, India historical risk, systemic risk have come only from five sources, no sixth, right? And if you come to know six, please let me know. I will upgrade myself, but broadly five risks, right? Number one, current account deficit. Our imports minus exports, right? So we import more and export less, right? So that results into deficit. So whenever our current account deficits have gone out of hand, we as a country start kind of struggling. So let's say in 1991, 2012, when we became part of Fragile Five, our current account deficit went to 4.5%, which has now come down to 1%. And as we've said in the multiple times in the past, also this next 4 or 5 years will become current account surplus. So this has got repaired. Whenever I think in 2012, when we became part of Fragile Five, 4.5%, our currency depreciated 20%, and entire economy went for toss. So this has kind of repaired very well. Number two, our fiscal deficit. Whenever fiscal deficit goes out of hand, we kind of as a country, government borrows more, interest rates go up, and economy starts struggling. Right. Today, our fiscal deficit is one of the best managed in the world, and this government has shown huge amount of discipline, and thanks to the tax buoyancy also in terms of sticking to the reasonably good quality of this fiscal deficit. Thirdly, our banking system. Whenever our banking system, goes for structural high asset quality issues, like so, whether it was 91, 2001, 2008, 2012, 2018, whenever our NPAs went in the system, entire economy comes suffers. Today, our NPAs are one of the lowest in the history. Our banking system is well capitalized, well digitized, and very well geared to grow. So and under leveraged in that sense. So banking system is in very good health. Fourth issue, or our fourth fault lines for us has been inflation. Whenever inflation goes out of hand, again interest rate goes up. Economy starts struggling. Today, I can again say that one of the best managed inflation around the globe. Think about it. If we did not import Russian oils, what would have happened to our economy, right? Right? There is a very nice saying that it's very hard to put value to the value of accidents avoided. What accident didn't happen, how do you put value? If we did not import Russian oils, I think our economy would have gone for toss. So I think inflation is one of the best managed right now around the globe. And lastly, debt to GDP or corporate debt to GDP, again at 75%, our debt to GDP is one of the lowest in the world, and only country post global financial crisis whose debt to GDP has come down. Our corporates are not levered. So I think that's again, very, very big thing. In fact, one of the another leverage one should know is, margin funding book in the markets. Historically, you could borrow margin funding with 20% margin and against any stock. So whenever market fell, margin funding accelerated the fall, because, margin funding calls would accelerate those falls. Today, because of SEBI's regulations, you can't borrow, with less than 50% margin right against only approved stock. So as a result of that, you have a huge comfort, and stocks don't sell when markets go down, right? So that to that extent, you don't have that another short-term volatility trigger. So all these five structural fault lines of our historical fault lines of economy are right now in a very, very good shape. And as a result of that, we don't see structural weakness in the economy and markets. Of course, for the risks I highlighted, in terms of short term, I mean, some of the pockets of exuberance, excesses, one must avoid. And I would keep on repeating that. And tell our investors with the folded head, please, please, please be careful in investing your hard-earned money in some of these names. I mean, today only I was reading one uh, message on one of the group that one two-store dealership company which went out in SME to raise 12 two-store dealership car dealership company, went out to raise 12 crores in the market. First of all, dealerships are not some great business to, two dealership are not great business to invest, but assuming it's a great business, they got 2,700 crores of subscription. This is not about investing. This is not about business. This is nothing but widespread casino game being played. So, some of these things one must be careful, one must be avoiding. But that does not mean that looking at these incidences, we start being, worried about saying that, oh, equity is not to be invested. Here is the role where it becomes very difficult that how to identify good quality company, good quality management at a reasonable price. And that is where I think, the job becomes a lot more difficult, a lot more hard. So these markets are not easy to invest. These markets are very hard to invest. And I tell all our investors, as our antenna of risk is very, very high right now. So even if in next, 6 months, 12 months, we don't outperform, we'll be perfectly fine. As long as we, manage the risk well, and we kind of course, will keep given the quality of our portfolio. One of the things which we're trying to show you, that are faster, stronger, cheaper, that earnings growth are fast, but more importantly, stronger. In times like this, resilience of a portfolio will be determined by stronger ROE, debt to equity ratio. Our debt to equity ratio is 0.1. That gives me biggest amount of comfort. Tomorrow, if something were to go wrong, at least my debt to equity, if demand were to slow down, my companies will not go belly up. And that is the, I think, very, very important part for us. And I would invite and request every investor to kind of keep the risk antenna very high right now, from an investing perspective. Yeah. So, the only thing, Tanay, if you can move the slide. So I think our thoughts on risk is always, risk comes from always unknown and unexpected sources. I can always give a very intelligent sounding answers that, oh, these are the 5, 6 big sources of risk. But my experience has told me that risk always comes from unknown, unexpected sources. The only way to prepare for risk is quality of the portfolio. And that's what our biggest focus is. Thank you very much. And, maybe we'll open the floor for the questions. We have about 10 or odd minutes, but we'll quickly take some of the questions. So please, raise your hand. You can ask a question. Meanwhile, I'll take, a few questions from the chat. I think defense stock, somebody's asking of you, Ramkrishna ji asking you that what's the view on defense stocks? I think clearly I said that there are pockets of exuberance. Defense is one of them. Defense is definitely greatest opportunity. But at the same time, there the valuation and exuberance is quite high. One has to be careful. Again, I'm not saying every company is bad and every company is, but one has to be very, very careful. I think somebody's asking any impact of on market of upcoming J&K elections. I don't think so. To be very frank, state elections will come and go. we have seen multiple times over the period of time that how we like to talk about it, but I don't think it's a really a big worry for us or uh, you know uh, uh, um, uh, these things will come and go. Kuton investment thesis. So I think it's a high quality tile company, luxury premium end of tile company, which will go public in next 12 months time. We got a very good reasonable valuation. We did pre-IPO deal in that, and we are quite positive. We like the management, we like the company, so at a reasonable valuation. So that's the reason we invested into it. Karan is asking, what's your take on power industry where EPS is growing at 20% CAGR? Valuation might be seen expensive on historic PE, but looking forward. So power is a sector, Karan, which is right now in a very interesting phase because as we know that India is staring at a power shortage. In last 10 years or so, there's no thermal capacity which has come, but the demand has grown due to infrastructure, manufacturing, consumption, everything, right? So we need to bridge this gap, and that's the reason I think, power and also power is, by the way, not only India's problem. I think globally, power sector was underinvested. Lot of things are being rebuilt in many parts of the world, including United States of America. So power is in a structurally reasonably good up move in some time, and I think that's how one has to keep looking at interesting play there. And we have some plays which we have invested on that. What is the overlap of stocks in Amritkal and compounder and shift? I think, there is a little bit of overlap. I think probably it won't be more than 15-20%. Each product differ, but generally speaking, between 15 to 20%. Impact of UPS, signs of weak government. Well, if government takes a decision which is, then it's considered autocratic government. But if government takes inputs and alter the scheme, it becomes a weak government. So again, we'll only probably know in fullness of time that whether it is an autocratic government or a weak government. But all I know that the government is a progressive government. They have done what probably no other government has done with this kind of reforms. And I think they are very growth oriented. So I do believe that at least we will continue to believe in what they are doing it. At least I know that UPS is better than the old pension scheme. So if your choice is to go back to old pension scheme or continue with NPS and lose elections versus be in the power and do UPS, I think probably this is better. So I would say that I'm not worried at this point in time. As government is coming with many subsidy schemes in many states for manufacturing setup, which whether this can boost small and mid-cap growth in next 5 years. I think manufacturing as a sector has been very big. We've been saying this for a very long time. Manufacturing, we continue to believe. Today, our manufacturing GDP is about $600 billion. This number by 2047 will go to $8 trillion, twice of our total GDP currently. That should tell you what kind of opportunity it is. Again, of course, the challenge is how to avoid frothy valuation and yet find good quality companies. And that is, I think, again, we think, our job is to do. How to invest into IT sector stocks in India, IT index or active IT mutual fund, please suggest. I think how to invest into IT sector, up to you. But that what you want to do, whether invest into mutual fund or index fund, we believe that there's a very massive opportunity for active investing. We don't believe passive is a great idea because many of our IT stocks, despite everybody saying that IT is not good, has delivered between 100% to almost 300% return, which I think probably no index of an IT would have given. So probably I think I am a big votary of active investing, generating significant alpha. And over next 10 years, at least, India will have that massive opportunity. It is up to investor to take or leave it. But and there's a very nice note we written, it's there on our website on active versus passive. I would strongly recommend you to read that. With US elections have an impact given the Republic Party is favorite. I think again, I don't think the US elections will have any impact, at least on India. Of course, and again, example I like to give is that in last 20 years, how many governments have gone and come? India stayed, internationally. Indian corporate profit, in 2001 was $8 billion. Last year it was $150 billion. In this period, we have seen all kinds of risks coming about: UPA 1, UPA 2, NDA, global financial crisis, 3G scam, coal scam, fragile 5 demonetization, GST, ILFS crisis, pandemic, Ukraine war, US elections. Everything has come and gone, right? India is a very, very, solid democracy with young population, and people who understand India opportunity well will benefit from it. And people, who are all the time focusing on, events which could potentially bring short-term risk will keep missing it. So according to me, look at India with the right lens rather than worrying about. In my career of 25 years, I have not had a single month where there is no event around and there's no risk around. It will always be around because some risk will be there. Next is Maharashtra election coming. Then, I'm sure there are some few next year as well. And some municipal elections are also there, which are very critical, by the way. So I think elections will be around, and but India is, doing well because India is an opportunity. Despite all the challenges we have had, I think India has done well. I think basis expected PAT growth, when do you see current market cap to GDP 150% range normalized to the level as per you? On the current market cap to GDP is something we should get used to going forward. So it's a good question. See, these broad numbers are, of course, very good to know, and especially in the mean reverting kind of market. But when you see something is structurally changes and something is structurally changing in a particular economy, it always tends to go a long way. And I would strongly recommend you to kind of go through our Bharat Amritkal pitch, but I will give you 2 minutes of window in that. You know, uh, Japan, as it went through this huge 25 years of growth period. 1945, Japan was broken post World War II. 20 years it took to repair. 1965 to 1989, Japan, had a massive boom. Almost I think 20-25x, and which is called Japanese economic miracle. At the peak of the market in 1989, Japan, which is such a small country, as a percentage of world market cap, it was 43%, right? And Nikkei traded at a PE of 60 times. Now, I will leave it to you to see what kind of, so, whenever transformation happens and these kind of growth comes, they tend to overextend. So I would say that, if you believe in India story, stay remain invested. Short-term corrections will come. There's no doubt on that in my mind. This $150 billion of current corporate profitability by 2035 likely to go to $1 trillion, meaning our market cap will be at a 20 PE, also will be 22 trillion dollars. It means Nifty will cross 4x from here. So if Nifty is expected to be 1 lakh, people like us do 2-3% more. I think you can make 6-7x return in this period of 10-12 years. So, it is the people who remain invested into India story will do well. Of course, risk needs to be managed the way I mentioned, that through remaining invested into good quality company management. Of course, that there is no alternate to that. But I don't believe Indian markets are anywhere close to peak. Indian markets are, of course, if you view 3 months, I don't know. If you're taking 5-10 year view, I think huge money to be made yet. Portfolio level risk from global clues, global recession. I think I am not worried about if tomorrow US was to go into hard landing recession, because I think our the reason why I'm not as worried, because our linkages on the liquidity side from the US is hardly anything. Think about it. Last time when US was kind of hardening, taper tantrum happened and our economy started sneezing. This time around, US raised 5% interest rates and we are growing and thriving. So we have kind of got de-linked from a liquidity perspective. From economic perspective, anyway, we don't export much to US. And fortunately because of China plus one, even if US degrows, our market share growth in that will compensate for the degrowth if US were to degrow. So I think market share growth is a great story which is working for India very well. So I am not very worried about tomorrow if you were to go into recession or low growth period, will India grow or not? I think India will continue to grow, and India will in fact outperform, but that will only going to trigger more fund flow towards India. And that's what I feel, that India will continue to keep getting re-rated. India will continue, the P will keep on getting expanded. Shrikant is asking that investment in Pakka, it looks Okay, small cap, what has been thesis on that? So I think Pakka is a packaging company which we have invested from a 5 to 7 year perspective. It's a very interesting 20% EBITDA, 20% ROE kind of company with the it makes from bagasse the butter paper and all those things, and very very solid company. And there are many more triggers in the company from growth perspective. They have just they are in the process of giving capex, so the profitability can grow 2.5 to 3x in next 3 to 4 years, and that has been our investing thesis. Ramakanji is in Bharat Nirman Fund. It's India Amritkal Fund, Bharat Amritkal Fund. Follow capex cycle was. So in India Amritkal Fund, we are investing across 5 broad themes: financials, manufacturing, consumption, services, and infrastructure. And there's no fixed allocation to each theme. We will keep modifying, adjusting based on a opportunity space view on the opportunity space, and specifically, more importantly, a company we find. Sometimes, even if we find something very exciting company or 3 exciting companies in a space, we will take that. So we will not really get guided by only fixed sector allocation or theme allocation, but it's a broad-based fund with the idea to kind of, again, broad objective we have is that in 5 years' time, can we make 2.5 to 3x return? And that is the lens which we pass through every company we invest into. And this will also be probably true in this case as well. The market cap to GDP I addressed. I think it's a repeat question. With the culture of freebie and new pension scheme being implemented, don't you think government will drain resources? Ajayji, I think India is the one. Historically, we always either followed a socialist model or we followed or countries followed only capitalist model. I think world has moved on. Today, I think India last 10 years has beautifully experimented that you can balance social welfare and capitalism. Right, one side, there's always accusation of wealth getting concentrated at the top. Other side, we complain about freebies. So my point is that, see, world is debating about universal basic income. I think India has already implemented that. As India gets prosperous, we have to have a social sector, underprivileged or lower strata of society, at least live a life of dignity, at least live a life of comfort, and they should be given granted that kind of opportunity. And I think that which I believe that has been given. Of course, it gets overextended to the extent where some of the signs you see at times which worries you. I think it will be worry point. But I think currently I feel that or I always believe that democracy, this government has a huge focus on fiscal. Consistently they have displayed fiscal constraint and fiscal balance, and net net, as long as they are managing the fiscal well, it should be fine. But yeah, they should not overextend on the other side where the productivity of the labor and availability of labor becomes a challenge. So it's a balance one has to constantly kind of work out. And currently, I don't see a very big sign of worry on that. Can you briefly on the banking sector, NIMs are under pressure. So I think financials, the very clearly, of course, in the recent past, deposit growths have been slower than the demand growth, and that has put a little bit of pressure on NIMs. And which has put pressure on the banking stocks. Our view has been on that slowly, it will sort of eve out, because if the deposit cost is going up, they will have to pass on to the investor borrowers. So it's a matter of intermittent adjustments which will happen. At point in time, they had a sharp expansion in the NIMs. Now you are going to see a bit of a contraction in the NIMs. But I think net, you will start seeing the credit growth in the industry coming through. Coming through. It is coming through, and it will credit growth which will drive the profitability of the companies. In the meanwhile, we have kind of shifted a lot of exposure to non-credit in the banking sector, so likes of insurance and other players. I think CDMO, somebody's asking, is the time to good profit? I had mentioned earlier that we see it's one of the very structurally well-placed sector over next 10 years, 15 years. It is where how IT was to India, CDMO space will be to, this is the next big bastion. So, idea is to remain invested and, of course, keep doing your research, but investing into big, good quality companies. And in fullness of time, you'll have many large $50, $100 billion market cap company also coming from this sector. Amritkal portfolio, we have fully deployed. We never been, from the day one we deployed because we are not bearish on markets. We are positive on the markets. More importantly, we are finding interesting companies to be invested. And as you've seen that in our portfolio, we have invested into very, very interesting differentiated companies where our conviction levels are very high based on the quality of the promoters we have taken bet on and based on the growth ahead of it and also right valuations. Like I said, if I can find a 25% earning growth, 19% ROE, zero point 0.1 debt to equity ratio. I think as long as I'm able to find this kind of profitability, there's no case for me to sit on cash, and hence we are fully deployed. And the day we don't find ideas, we will sit on cash. I think Rahul, bespoke portfolio, basically the customized portfolio we do for clients, where we take minimum 20 crores and, that's a more concentrated portfolio, 5 to 10 stocks portfolio. We can definitely, if you are interested, we can definitely have a chat, even reach out to us. We will love to explain you more in detail, but it's more concentrated, bets. We can't do 10 lakh scheme because of SEBI regulations. So, you'll have to bear with us. That's not possible. If market corrects, do you believe beta of your portfolio is such that down will be less? Yes. Actually, that's what beta is supposed to tell us. That, if markets correct, beta of portfolio is lower means we should correct less. And more importantly, I mean, short-term corrections never bother me. More importantly, like the quality of the portfolio, I showed that even if it correct more, because many times in pandemic, I remembered most investors sold what could be sold. So high quality got portfolio actually got beaten on more, and because they could be sold, they were liquid. So, we had taken more beating, but when it recovered, we recovered fastest. So I think, depends on what kind of fall comes in, but in a normal fall, we will take less beating. That is what beta is supposed to tell you. India is actually attracting investment in electronics like Foxconn, Samsung, Winstone, Satellite. Don't you think it is a threat for Indian manufacturing company? No, all these big manufacturing companies are like the way to think about it. They are coming here, and it's like Maruti coming to India. When there was no car manufacturing, Maruti and Honda came and setting up the manufacturing facility. And in fullness of time, they started with assembling and then they started manufacturing, indigenizing. And today, 99% of the parts are indigenous, and entire auto component industry is best in the world and competing with the best in the world. So it is that kind of trend where they are setting up right now, early stage, and then we will kind of, see whole ecosystem getting built. So it's only that kind of setup. And in fact, it's good that when they're coming and setting up at least manufacturing is coming up, and then the entire ecosystem in next 5, 10 years will be, which will create even far more better opportunities, employment and growth. And many of the Indian EMS companies are going to be, Tata has set up 5,000 crore capex supplying to Apple, many various components. So component industry or component ecosystem building is very, very critical for any mainstream OEM industry to grow. Today, lots of Indian companies are able to do automobiles, cars, and all those things only because of the component system which we got built. So I think impact of Ukraine-Russia war, I guess this is probably more theoretical questions. I think it's been going on for more than 1.5 years. So you've seen the impact. So I think, we are in a heightened geopolitical situation, which will remain like this for next 10, 15 years, in my opinion. Sadly, wars is good for business. But at least India is well positioned from a geopolitical perspective. Of course, it's not that we will not have any suffer from that, but defense is going to be one of the biggest sector, both from domestic as well as export perspective, because of this geopolitical situation. Many countries are bombed and they are going to rebuild. So Ukraine is being rebuilt. So all those kind of things will be there. But I don't think, there's any meaningful impact. Good part about India is the way to think. A lot of questions on risk. I will again say that revisit what I said about 5 fault lines of India, historical, they have got repaired. So, they are like our vital parameters of a body. Viral attacks will come in various forms, sometimes state election, sometime you war, sometime you. But if viral attacks will come, if my vital of my body are strong, I will have 2-day fever and then, I'll recover back. But if my vitals are weak, I will go to ICU or my organ failure might happen. So today our vitals are very strong. So even if wars come or any unprecedented event comes, which will have short-term impact on us, but because of this five vitals of our economy being very strong, we will come back very fast. And that is how there are lots of questions on risk which are short-term, tactical. I would say, please evaluate all your questions on risk around that framework. That will give you a lot of answers. Because otherwise, I'll keep answering only those tactical risk questions. But according to me, all these are, risk will be around, risk will continue to be there. Just process from that point of view. View on EMS sector. EMS is a sector where you have to be very, very careful because again, there are a lot of low margin business trading at a high valuation. So we have one or two companies, but we don't have many companies in this space because we think that, in a low margin business, you can't 4, 5, 6% margin business, you can't pay 70, 80, 100 P, right? Because while companies might grow, but I may not make money. So we've been very, very, very careful on that space. And I don't think we have, I think only probably one small stock in that, but not really many, ideas in that. Currently, this sector is one of the very, on a watch list for the risks kind of sector. I think we have probably covered most of the questions. Then I think is there any left? I guess probably I think I'll, uh, once cheap Russian oil is not available, Sumit, I guess why it will not be available, I don't know. But it's not available, first, I think oil prices are coming down. Only reason why oil prices initially went up because Russian supply was blocked. The moment Russian slide supply was opened, then people said there's no point in rigging the price up. We all know that oil is right now also overpriced, given the fact that 10, 15 years down the line, oil may not be needed. So it's a overpriced asset today also. But because of the cartel, it is where it is. And the moment that cartel was broken, everybody else fell into the line. So I think India did a great job in breaking that cartel. And I do believe that oil is also, especially given the global slowdown in offing, oil demand is not going to be very, very strong. And hence, generally speaking, oil is not a bullish segment for us. I think Keshav, you have asked 3 times this question. Please check Pakka's holding. It's factually incorrect. There's no 85% holding pledge for the Pakka, the promoter. It was pledged long time ago, like for the bank in favor of banks who had given loan to the company. It was not promoter borrowing. So that has got released in the recent past. So Rahul, I think DTC does not mean that long-term, short-term capital going away. So we should actually, in my opinion, not think too many unprecedented things. I mean, government is sensible. Whether what to do with the capital gain, not to do with the capital gain. I don't think capital gain going away is a situation. Even if it were to go away, we will revisit that point in time because today I can't do anything about it. I have no specific insight to tell you that whether long-term capital gain will go or not. China plus one strategies are working on the ground already. Probably you are not privy to that. We see this every single day in every of our company. We see in every sector, in many sectors, in many companies, every single day on the ground. So it is already in the place either in form of import substitution and export. So I think, with this probably we will pause because I think we've taken a lot of your time. I think thank you very, very much. We really value. If you have any more questions, please feel free to write, to us, reach out to us. We really value your time and every quarter this interaction. Thank you very much.
We'll wind up the session.